Okay, so good morning, everyone. Welcome to today's macro snapshot. Relatively uneventful overnight session. So it is, for the record, Thursday, November the 16th, 2023. So let's just have a look, bit of review, see what's going on. We could see yesterday, obviously we had that sort of huge move that, on, when was that, like Tuesday? And that was sort of partially reversed yesterday. And possibly that's just because the data, the market decided that the data, let me just bring this in here, was a little bit hawkish, and maybe the sort of dovishness had been sort of overdone a little bit. And we just look at here the retail sales. Now, the retail sales in themselves were nothing crazy, but we did get the revisions first of all. Just keep in mind that the revisions here were a little bit higher than last time. So that's sort of solid, plus a little bit there. But also, if you look at the control group here, the control group, came in as expected. And pretty solid. So the point is, it was, relatively solid, nothing sort of collapsing there. Also, what was interesting is the Empire Manufacturing, which is for the Greater New York area, of course, the manufacturing survey there, that came in at 9.1 instead of -3. So that was quite solid. What got my attention, which I thought was an interesting market reaction, was that the PPI came in, to be honest, quite dovish. I mean, as you guys can see here, everything was revised down and it was lower than expectation. So clearly the cost of input prices for producers is going down. And on the back of the CPI, which was sort of dovish on the Tuesday, that could have been taken either way by the market. Now, the market could have taken that as a confirmation and continued to push the sort of dovish reaction of Tuesday. Or on the other hand, another way of sort of looking at that sort of a slightly different perspective is to say, well, hey, the PPI was expected after the weak CPI print to be relatively weak, and that the retail sales, all in all, was fairly solid. It wasn't spectacular, but certainly it doesn't indicate an American consumer which is losing their purchasing power. And then you also see that the Empire was pretty strong. On top of that, before the bell yesterday, we had Target reporting, which had a pretty good sales. So again, the whole idea that Target had a very good sort of performance, and then that the retail sales was solid, Empire Manufacturing strong, and you could argue that the PPI was sort of priced in. I think basically at that point the market decided that maybe things had gone a bit too far on the Tuesday, and it took just like just a moment for a bit of profit taking. So if we look at a couple of charts and stuff, I think a lot of that also was, we're in very sort of overbought territory at this point. So if you look at something like the NASDAQ, let's just have a look here. I'll just put it on the futures, the NASDAQ futures. You can see here that we did, pop initially on the PPI print. You can see that pop happened at 8:30 a.m. yesterday. You can see that that's coming up to sort of overhead resistance here around about whatever that is, just over 16,000 here, which is a nice number. Would not have surprised me. A lot of people, who had been on this rally, that's a beautiful moment to take profits there. So I think probably quite a lot of profit taking. It also coincides with this sort of uptrend, this gray line here. You see this sort of pretty ongoing sort of uptrend line there. So just a good moment to take profits. Similar kind of situation on the ES. I mean, the chart is not quite as clean, but again, we're starting to sort of test highs. And just with all of that there, you just have to say that the market was maybe like, whoa, maybe time to take a little of a break. What was interesting for me over the last couple of days is that the Russell outperformed the sort of the other indexes, but again, this is again some high sort of overhead resistance here. So the Russell also just deciding to take a pause. So my point is that I don't know that this rally is necessarily over as such, but certainly what's going to be interesting is really how the market reacts now. So it reached its targets. It's had a very sort of solid run up. So let's see what happens. I mean, let's say, for example, looking at the Russell, you have you could do that like the measured move here, and you can see that on the Russell, that measured move measured out perfectly. That sort of Fibonacci extension. So really now it's going to be a question for all the indices. We'll just go back to the ES here of how they react. So you could argue that, I mean, this is not a perfect kind of Fibonacci extension here, but in fact, I'm really not really loving this one at all. But you could argue that that measured move also went to where it needed to go. So now the question really is, okay, so what happens now? So if you could start doing a sort of Fibonacci here and say that even if this were to sort of come back, sort of around this 4430 level, or even a deeper retracement here, that is still, the bulls are still, they haven't lost control. Or if you do it on a sort of a shorter term impulse here, maybe, something which could be more interesting is to say that, maybe something like this level here, 4467, 44.68, 44.69, 44.70, whatever, something like here. If this pulls back here, the bulls, this impulse, this bullish impulse is still in place. So I definitely, throw a couple of Fibonacci's on and just sort of see, pose a few questions. The market needs to answer those questions. So I think in terms of the stocks, today, we have a little bit of data. We have initial jobless claims. Let's just have a quick look at the numbers here. We can see that we have, let's just move this. I've got stuff on my screen. So you can see here we have initial jobless claims, which are expected to come in at, expected to come in at 220,000. So slightly high uptick compared to last week. But the reality is we need to be looking at a 4-week sort of moving average of that just to flatten out the volatility a little bit. The point is that from a historical perspective, anything in the low 200s is still a very, very healthy number. This is a labor market which is still very, very strong. Now, it's going to be interesting as well. We have the Philly Fed outlook coming as well at 8:30, and that's just interesting because that was expected to be -8 on the back of the Empire survey from New York, which was very, very strong yesterday. Just be interesting to see if that's confirmed or negated. Just looking at some earnings here. Macy's sees 2.88. Also, Macy's underperforming. Okay, a little bit of weakness there in Macy's. We also, of course, today have a Walmart reporting, so which actually that number should be coming out relatively soon. So again, it's going to be quite interesting to see the market sentiment today. If Walmart supports, what Target was strong earnings, or maybe Walmart's a slightly different one. So let's have a look and see what happens to Walmart today. So just getting back to some of the charts, the other charts I've been looking at is oil. So let's just have a look at oil here. Where are we? Just going down to oil. Oil is weak. The chart is weak. I mean, at this point, let's be honest, we've had, the measured move was done, great, from here. So we had this Fibonacci extension down to about here. We had the horizontal resistance, and could we have expected a bounce? Yes. Did we get a bounce? Yes. But was that bounce extremely weak? Yes. And we're going down again. Now, you could say it's bouncing a tiny bit this morning, but this is, a small change. At this point, really you need to start seeing the bulls, come up with, I mean, if we take the full sort of Fibonacci here, you can see that this so-called bounce here was, and I'll just sort of highlight it here in the orange. You see this bounce here was extremely weak. This bounce could not even get up to, certainly not a 38%. And even if you say, well, okay, maybe I'm being a bit aggressive there, you could see it, let's say, on this kind of impulse, not even to the 38. And if you go being very generous here, you could say couldn't get out of the fib zone. So the point is that this bounce has failed. And so now it's really up to the bulls. At a minimum, they have to go up and retest this, 70, let's call it the $80 mark. Until they can start doing that, we might reconsider. But at this point, this chart is weak. All the time spreads are weak. And I just did a snapshot this morning just to show you guys just some quick numbers here if you're looking at all the different time spreads. And you can see that the prompt spread, so December, January, minus 22 cents on Wednesday, flipping to a contango of 13 cents. So, of course, contango is when the front contract is actually trading cheaper at a discount to the next contract. And we haven't seen this for many, many months. This is a bearish signal at this point. I'm not saying this cannot change, but at this point, the market is showing negative sentiment. If we also look at M2, M3 months, so that's month 2 to 3s, that's also in contango, the weakest since late June. If we go, let's say, do a 6-month spread, month 1 to month 6, that's minus 76, weakest since late June. And if you do a full calendar year, M1 to M12, that's also the weakest since there. And the December contract, which the market likes to look out for a medium-term prognosis, is the weakest since late June, down to 260. Remember, guys, that December was up at, I think, about $12 or $13 a couple of months ago. Okay, so the point I'm trying to make here is that the time spreads on oil are very, very weak, and that's a sign that the physical market is simply not tight. And it was interesting. Yesterday we got a survey saying that Saudis expected to prolong their 1 million barrel unilateral cuts in the first quarter of 2024. The market flicked up 3 or 4 cents and then promptly continued on its path downwards. So could oil go a bit higher? It's possible, but at this point, the chart and the time spreads are telling me that the market is weak. Now, so for me, I think there's a couple of tests for the bears. The bears will say, well, okay, we need to first break this $75 mark. It's on the CL1 contract. And then probably really, you've got to say at that point, if they break down there, for sure they're going to test down to the 73.91. And if that cannot hold, you're looking at a retest, you know, a significant test down maybe another $10. Now, I know that seems a bit far-fetched at this point, but the point is that's the way the oil market works. It'll keep on testing and testing. You know, and even if the Saudis do come up with, you know, sort of more cuts, that is coming from a position of weakness. That is indicating that global demand is so weak, or is in a position such that they are obliged to cut more. The Saudis do not like to cut production. That means they get less money. Anyway, so that's that. So let's keep a lookout for oil. Just by the way, guys, looking at nat gas, is still, you know, just trading along its lows, not great. But if you look at the December contract, you see here, that's the CL1 contract I showed. If you look at December contract here, falling lower and lower, and that's just because there's like an increasing, there's a lot of oil production coming out of the US, the Permian Basin, and the side product of that, there's a lot of flaring off of nat gas. So there's a lot of nat gas being produced as a byproduct to oil, and there's just too much, you know, combine that with, you know, relatively mild winters so far in China, in Europe and across Northern America, there's just not that much interest in nat gas. And also, if you look at Europe, for example, the storage tanks are very, very full because of the Ukraine, you know, the crisis from a year ago. So there's just not much demand. There's just not enough demand for nat gas, and it just continues to bleed lower. Just talking about nat gas today at I think 10:30, no, maybe 11 o'clock, we get the EIA numbers. Which, you know, maybe will give us a bit more information. Oh, talking about EIA numbers, of course, yesterday we got the 2 weeks worth from oil, and there was a build there, a very, very large build as well. So the inventories also are not supportive. We have higher inventories at the Cushing delivery point for the WTI contract for oil as well. So just the inventories, I forgot to mention it, also building up. Just in terms of other stuff, we saw yesterday just a little bit of correction in most of the markets. So we saw that the dollar on the back of that weaker CPI had a huge fall on Tuesday, just kind of, you know, just consolidating. I wouldn't say it's pushing back hard, but just sort of consolidating at this point. And you've got to say, I mean, it's an interesting one for the dollar, because if you subscribe to the dollar smile theory, that the dollar only shows relative weakness when you know, it's when the other economies are doing, like when the Fed enters into a sort of a more dovish phase, not yet a cutting phase, but let's say a non-hiking phase, and other economies start to do better. That's the only sweet spot where the US dollar might show a little bit of temporary weakness. Can you argue that we're in that regime or about to go in that regime? It's possible. I mean, if the data in the US continues to soften, if the Fed sort of indicates more or less that they're definitely not hiking anymore, and if we start to get some green shoots over in China, you know, is China starting to do well, starting to stimulate a bit more? Is the European economy stabilizing? Yeah, for sure, we might continue to see the euro, you know, doing relatively well. But I think, you know, I mean, can it push up to 109 on the euro? Yeah. But I just think medium term, the dollar, any dollar weakness will really have to wait for, you know, a true pivot from the Fed, which personally I think is maybe 3, 6, 9 months away. So that's just something to look out for. But anyway, just on the back of that slightly more dollar, US dollar strength yesterday, we've just seen, just sort of temporarily, we see the Aussie down. We see the New Zealand down. And it's interesting about the Aussie because we've got employment numbers last night. The headline number came in about 55,000, which was much, much higher than expected. That was a 3 standard deviation kind of beat. But the problem is that the unemployment rate ticked up 1/10. And also, if you actually break down those 55,000 jobs, I think the expected was about 24,000 from memory. Actually, I have the numbers here. Yeah, 24,000 came in at 55. So that looks like an amazing beat. But the problem is that most of those job gains were in full part-time jobs. They were not full-time jobs. So the market looked at that and said, nah, the headline number looked pretty strong. But once you look at it, actually it was more part-time jobs. And then the unemployment rate ticked up 1/10. So basically, Aussie was beaten down quite a lot there. So that's just a sign that the sentiment, you know, in the APAC, Asia Pacific region is not super strong, and we see that with, you know, New Zealand dollar just coming off its highs, Canadian dollar just, you know, giving back a little bit as well, just on also the softness in the oil prices. So the thing is that US dollar also, you know, we see that the US dollar just crawling back a little bit higher against the Japanese yen as well. So, you know, despite the fact that the US dollar did come off pretty significantly on the back of the CPI on Tuesday, you know, I think continued weakness will not see that, as I say, until maybe it's a 2024 story. In terms of gold, just meandering along at this point, guys. You know, it had the 38% retrace, and, you know, all the moving averages there, we'll just throw them on. You can see there's a cluster of the 100 and the 200-day moving averages pushing up. I think gold here, I mean, it's hard to say. We have, the yields, maybe it's more of a yield story here and the US dollar story. So let's just, have a quick look at what's been going on. And what I might show you here, guys, maybe this is one way to look at it, is if you look at the short-term interest rate, like the SOFR contracts, which is, the short-term contracts, which is sort of a reflection of where the market thinks the Fed might be going. This is here showing the spread between December 23 and December 24. And essentially this number here on the right is the discount, which is to say the number of cuts priced in the relevant time period. So what we can see here is that on the back of the weakish CPI on Tuesday, you see the market had been pricing at about 85 basis points of cuts, so just over 3 cuts. And then it went all the way down to 107, so over 4 cuts. Yesterday, a bit more hawkishness, just gave back about 50% of that. And now, as you see, we're basically in the midpoint range there. So at this point, the market's pricing in, let's keep life simple and make it about 100 basis points there, which is like four different cuts. So you've got to say, are there 4 different cuts? And it was interesting just reading a few articles over the last few days. A lot of the big banks, JP Morgan, Goldman Sachs, UBS, they have wildly diverging viewpoints basically on this chart here, because you have something like, I think from memory, UBS saying that they think the Fed is going to cut, 250 basis points. So if you believe UBS, I mean, this number, this chart should be down here somewhere. They're basically saying that, the Fed is going to be cutting all, like 200 basis points, 250 basis points all the way down here. On the other hand, you have, people like Goldman, I think from memory, who are basically saying the Fed's only going to cut maybe once or maybe twice. So that number should be, the chart should be looking something like up here. So a very wide divergence, very choppy, difficult to hold positions longer term here, unless you want to make a big bet. But you could be, you could be very right or very wrong. I think the best way to be playing this is sort of short-term tactical kind of moves. Is if you can get onto some of these moves, it's difficult with the algos. But just to say that even the big institutions are very, very divided about, when and if the Fed will cut. Let's just say at the moment, the market consensus is in the middle. It's about 100. And maybe that's something, which the market is relatively happy with at the moment. And you can see that just to have a quick look here. Again, you can see that just in the 2-year yields, you can see here, again, a similar kind of situation to the short-term interest rates, sort of dovish repricing after the CPI and giving back half of it. You can see even out the long end on the 30, very similar kind of situation here. So the market is is volatile. Let's just put it like that. We look at the MOVE index, which is Harley Bassman's of volatility. You can see here that the volatility is up, it's down, and it's up. But on a historic level, you can see that even though this seems to have come down from its highs, on a historic kind of level here, we're still at relatively elevated levels. And what the stock market will need, the stock market does like a lower MOVE index. It likes a lower VIX as well. So, again, you see that, the MOVE index of, by the way, those who don't know it, the MOVE index is implied vol on a broad basket of treasuries on bonds. Okay, you see that came down, that gave a bit of a kick of support for the equity. So let's just keep on looking at that. That's about it. As I say, for today, guys, that's, the other thing, we had the President Xi of China and the Biden meeting yesterday. I mean, a lot of people are piling into into FXI, the large cap China one. As you can see, they've got a little bit of support, giving a little bit back, but not doing too badly yesterday on optimism. But as you can see in the pre-market down here, and basically, there was the thought here that it wasn't a bad meeting. There was, Biden called Xi a dictator in his press conference, which is highly true, but maybe wasn't the most sort of diplomatically sensitive timing to say that just after their 4-hour meeting. But I think the point is that the market, you can see here the FXI down in pre-market, a little bit disappointed that there weren't more substantive progress made. I mean, it's a useful, dialogue point. If we also just look at some of the Chinese indices here, which we like to look at, you can see here, for example, the A50, big red candle. If you look at the Shanghai 300, red candle. If you look at the Chinese stocks traded on the Hong Kong Hang Seng, also a red candle. So the immediate reaction from at least the Chinese indices is, like, that wasn't so great. So China for the moment is, looking not, the most positive thing. Okay, guys, I'm going to leave it there. Initial jobless claims and was it the Philly Fed at 8:30? That'll give us a little more data. And of course, I'm pretty sure we had Walmart as well. Actually, just have a quick look and see if Walmart actually has reported. Sometimes it comes out just while I'm doing this stuff here. Spain. Oh, there we go. Walmart. I think we're seeing a few headlines there. Came out at 7 o'clock. Walmart EPS. Let's just have a quick look, just the pre-market, just to have a look and see how Walmart is actually trading, guys. Just if you will bear with me here for 2 seconds here. Let's put it on the stocks. Just see if there's any sort of initial reaction here. Just put it on a 1-minute chart here. Yeah, you see the pre-market, the market not liking that. So Walmart are down trading in the pre-market. So that might put a little bit of negative energy into the stock market today. We shall see. Okay, guys, I'll leave it there. Have a great day, and let's keep on talking. Thank you.